Imagine finding the perfect place only to realize it's way out of budget and you can't afford it. In this video, I'm going to break down what you can actually afford in 2025 if you're making around $80,000 per year. Hey guys, my name is Ben. I'm a mortgage broker in Kelowna, British Columbia, and I help first-time homebuyers get it right so you don't end up house poor, wasting your time, or caught in the middle of some financial mess. Buying your first place can be exciting. Figuring out how much you actually can afford, that's where a lot of people get stuck. And in 2025, it's not just about how much you can spend per month. It's about what you qualify for. One of the biggest hurdles here is called the mortgage stress test. You may already know about this, but if you don't, this is how it works. Even if you're offered a rate of, say, 5%, the lender doesn't qualify you using that number. They legally have to test your application at a higher rate, whichever is higher, between 5.25% or your contract rate plus 2%. So in this case, you're actually being qualified as if your rate was 7%, not 5%. This rule, it applies to all federally regulated lenders in Canada. That means banks, most credit unions, and large financial institutions all have to follow it. The only real exceptions are some alternative lenders or private lenders, but for most first-time homebuyers, especially if you're putting less than 20% down, you're working with an A lender, so the stress test is going to apply. It's designed to create a buffer to make sure that you can still afford your mortgage if the rates were to go up. And it directly affects how much you can borrow, even if your personal budget could technically stretch a little further. So if you're wondering why you qualify for less than you expected, that might be the reason why. Lenders also look at two important ratios to figure out your affordability. First one is the gross debt service ratio. That's the portion of your income that goes towards housing. Things like your mortgage payment, your property taxes, your heating, and if it applies, half of your condo fees. Lenders want this number to stay under 39% of your gross income. The second one is the total debt service ratio. This includes housing plus any other monthly debt that you're carrying. Things like car loans, student loans, and credit card payments. This one has to stay under 44% of your gross income. So even if you're comfortable spending a bit more, if those ratios are off, the lender will cap you a little lower. To keep this example clean, simple, and realistic, what we're going to assume is you make $80,000 a year, which breaks down to just under $6,700 per month before tax. The lender lets you spend up to 39% of that on housing. That gives you a max housing budget of $2,600 per month. You're going to be putting 5% down, which is the minimum required for homes under $500,000. And because you're putting less than 20% down, this is considered a high ratio mortgage, which means it requires mortgage insurance. It's usually provided from CMHC or another provider. This insurance doesn't protect you. This insurance protects the lender, but you pay for it. The cost gets added to your mortgage, slightly increasing the size of your loan. We'll be using a 5-year fixed rate of 5% with a 25-year amortization, which is standard for insured mortgages. And we'll stress test your application, which means we're qualifying you at 7%. We'll also factor in property taxes at about 1% of your home's value annually, and we'll add heating costs at about $100 a month. And for simplicity, we're assuming that you're buying a townhome or a low-fee condo, something realistic for first-time homebuyers without major strata costs that throw these numbers off. And if you were to plug all that information into a simple mortgage calculator, one that includes taxes, heat, and CMHC insurance, you would see that your buying power lands you between $350,000 and $400,000 price point. But let's go with $400,000 as our example. At that price, you would need 5% down, which means you would need a $20,000 down payment. That'll give you a mortgage amount of $380,000. At that amount, your monthly principal and insurance at 5% is roughly $2,100 to $2,200 per month. Add in $300 for property taxes and an extra $100 for heat. Your total monthly housing cost should be around $2,500 per month. And if you remember, that's just under your $2,600 gross debt service limit. so you pass the stress test and likely qualify. But if you do want some extra breathing room, I'd recommend looking closer to the $350,000 price point, which could save you a couple extra $100 a month. It could also boost your chances of approval if you're carrying any extra debt. So what does $350,000 and $400,000 budget actually get you in BC? Well, in towns like Kelowna, Langley, and Abbotsford, you're more than likely looking at a 1-bedroom condo, a small 2-bedroom condo, probably in an older building, or one that's further away from downtown. But in smaller towns like Vernon, Salmon Arm, or Duncan, your money's going to go a lot further. You might actually find a townhouse, a half duplex, or even a larger condo with parking and a bit of outdoor space. But a detached home, honestly, at this price point, it's not going to happen unless you're in rural BC. But if you're flexible on location, there are still some solid options out there. Everything we've talked about assumes that you don't have much other monthly debt. If you've got a car payment, student loans, or you carry credit card balances, that will eat into your total debt service ratio, and it will lower the mortgage amount that you qualify for. So before you start looking, do yourself a favor and get pre-approved. It's free, it's easy, and it will give you a clear number based on your actual situation. When you know how much you can afford, the next step is to match that number to the market that you're in. Let's say you're pre-approved for $400,000. You're going to want to aim for homes that are priced maybe between $380,000 and $420,000. It'll give you room to negotiate and walk away if something feels off. And just because the lender says that you can spend $2,600 a month doesn't mean that you should. If your comfort zone is $2,300 a month, stay there. Owning a home is great, but being house poor, that isn't any fun. Guys, if you found this video helpful, do me a favor and hit that silly little like button, subscribe to the channel, or send this video to someone else that might find it helpful. If you have questions, if you want a review of your own situation, go ahead, send me an email, book a call with me. All my links are in the description below. And as always, thank you for watching. I'll see you in the next video.